China and Iran have recently inaugurated a direct railway link designed to facilitate the transport of oil and other goods, effectively bypassing traditional maritime routes and third-party countries. This is something that scares the hell out of the U.S. This strategic development is part of their broader 25-year cooperation agreement, which encompasses significant Chinese investments in Iranian infrastructure, including railways and ports. The railway enhances China's Belt and Road Initiative by providing a land-based corridor that reduces reliance on the Strait of Hormuz and the South China Sea, regions susceptible to geopolitical tensions. By streamlining logistics and minimizing exposure to U.S. sanctions, this rail link strengthens bilateral trade, particularly in the energy sector, and underscores a shift towards greater regional integration and autonomy from Western-dominated trade networks. It also allows China to rely less on the Strait of Malacca, which is the busiest maritime trade area in the world and is susceptible to naval choke points. Anyway, let's take a look at China's new oil infrastructure ambitions and why this scares the U.S. so much. In March 2025, China's imports of Iranian crude oil soared to unprecedented levels, as traders and refiners accelerated purchases in anticipation of potential tightening of U.S. sanctions on Tehran. Data from ship tracking firm Vortexa indicated that imports exceeded 1.8 million barrels per day, while analytics firm Kepler reported a figure of 1.71 million barrels per day, marking a 20% increase from February and the highest in 5 months. This surge was largely driven by independent refiners in Shandong province, who increased their inventories by 22 million barrels, the largest monthly rise on record, aligning with the influx of Iranian oil. Industry experts attribute this stockpiling to fears of further U.S. sanctions that could disrupt supply chains, but this has flipped the whole script. China just gave a big middle finger to the U.S. and said, "I don't care about your sanctions," while building more logistical capacity for Iran and other nations. Despite international sanctions, China continues to be the primary destination for Iranian oil, accounting for approximately 90% of its exports. To circumvent restrictions, much of this oil is transshipped through regions like Malaysia and Singapore and rebranded before reaching Chinese ports. The increased demand has also led to a higher number of vessels, attracted by lucrative fees, replacing those previously sidelined by United States sanctions. Consequently, Iranian oil constituted 16% of China's seaborne crude imports in March, according to Kepler. Analysts suggest that the current buying spree is a strategic move by Chinese refiners to secure supplies ahead of any further geopolitical developments that might impact the availability of Iranian crude. Emma Lee, a senior market analyst at Vortexa, noted that the elevated inventory levels have empowered Shandong's refiners to negotiate better terms, allowing them to slow down purchases and seek greater discounts for future deliveries. Despite expectations of reduced imports in April, demand for discounted crude remains strong, supported by improved refining margins as global oil benchmark prices have declined. Additionally, China's seaborne crude imports reached 10.6 million barrels per day in March, the highest since October 2023, driven largely by the record Iranian crude arrivals into Shandong. Floating storage of Iranian crude in the South China Sea decreased slightly, from 33 million barrels at the beginning of March to 30 million barrels by month's end, indicating a swift movement of Iranian oil eastward ahead of potential supply constraints. In parallel, China's imports of Russian crude oil rebounded to 1.3 million barrels per day in March, aligning with the 2024 average. This resurgence was primarily due to increased purchases of Far East grades like Sokol and Sakhalin blend, which had been stranded since earlier in the year. These acquisitions helped offset declines in long-haul Urals and Arctic crude imports, which faced limitations due to a shortage of non-sanctioned tankers following U.S. sanctions imposed on January 10th. Notably, a very large crude carrier, VLCC, previously involved in Iranian ship-to-ship transfers, was observed delivering Russian Arctic crude to Shandong, suggesting that Russian barrels were offered at even steeper discounts than Iranian crude, appealing to cost-sensitive refiners. Approximately 20 million barrels of Russian Arctic crude are currently en route to the Far East to meet Chinese demand, according to Vortexa. The growing surplus of sanctioned crude is expected to intensify competition among suppliers and may encourage new participants in the dark fleet to engage in ship-to-ship transfers within the South China Sea as traders seek to capitalize on the demand from Chinese refiners. It's not just so-called developing nations that China is buying more oil from. Canada is another market which is seeing massive buying. China is rapidly boosting its crude oil imports from Canada while drastically cutting purchases from the United States, according to Bloomberg. Amid deepening trade tensions with Washington, Beijing has reduced its imports of American oil by around 90% compared to earlier periods. Meanwhile, China's appetite for Canadian crude has soared. In March alone, imports from Canada's Pacific coast hit a record high of 7.3 million barrels. This trend is expected to continue growing, especially after the expansion of Canada's Trans Mountain Pipeline, which now facilitates direct exports to Asia. Previously, the majority of Canadian crude was routed south to U.S. markets, but the new infrastructure offers Canadian producers access to broader global buyers, particularly in China. Analysts suggest that Beijing's move is a strategic retaliation against U.S. policies without formally imposing new tariffs. This shift in trade patterns is likely to have significant long-term effects on North American energy markets, especially seeing as the U.S. recently pissed off its neighbors. 50 years ago, China's oil refining capacity was minimal, well under 1 million barrels per day. However, Deng Xiaoping's economic reforms in the late 1970s allowed the government to prioritize and invest heavily in energy infrastructure, which was much needed because of China's rapidly growing manufacturing base. By 1990, it had grown to 2.5 million barrels per day. Between 2000 and 2020, China's refining capacity expanded dramatically, fueled by rapid urbanization, soaring automobile ownership, and growing manufacturing output. By 2020, China's refining capacity exceeded 17 million barrels per day, surpassing the United States for the first time. Major state-owned enterprises like Sinopec, PetroChina, and CNOOC led the construction of enormous, complex refining centers known as mega-refineries, capable of producing not just fuel, but petrochemicals crucial for plastics, pharmaceuticals, and electronics. Investment into refining infrastructure has been staggering. Between 2010 and 2020 alone, China invested over $400 billion into refining and petrochemical projects. New facilities, such as the 800,000 barrels per day Zhejiang Petrochemical Complex, represent some of the most sophisticated refineries globally, capable of processing a wider range of crude types, including heavier and sour grades that are cheaper and often overlooked by others. Central to China's refining rise has been strong government support. 5-year plans consistently emphasize self-sufficiency in energy, commanding state-run companies to build domestic capabilities. Beijing also offered subsidies, favorable land access, and tax incentives for refineries. More recently, China introduced a dual circulation strategy, aiming to boost domestic consumption while shielding supply chains from external shocks. This includes maintaining vast strategic petroleum reserves and encouraging companies to refine and export petroleum products, turning China from a crude importer into a fuel and petrochemical exporter. China's refining dominance has reshaped global energy flows. With its mega refineries, China has created supply chains less reliant on Western oil majors. It has deepened energy ties with Russia, the Middle East, and even Venezuela, often purchasing discounted crude shunned by other countries due to sanctions. China's vast refining network enhances its energy independence, giving it leverage in trade negotiations and shielding it from disruptions like U.S. sanctions or Middle East instability. Furthermore, by exporting refined fuels, China challenges traditional suppliers like South Korea, Japan, and even parts of Europe, altering regional energy market dynamics. It's clear that China is the growing energy giant of this century. It is both a massive consumer and refiner of petrochemical products, meaning it has an incredibly vast market for oil exporting nations to tap into. And it's not just oil that China is ramping up. It's by far the largest renewable and nuclear energy user in the world. All of this is in pursuit of one thing, energy independence, and it annoys the U.S. so much that they can't push China around anymore. The China-Iran Railway is just the beginning point in a series of large planned infrastructure projects that connect Asia to Europe and Africa. World power is shifting, alliances are changing, the new age of multipolarity is here, and China is undoubtedly a major player. If you enjoyed this video, then please like, comment, and subscribe. Thanks for watching.